all that really translates to is don't be greedy, right? Like the greed would be all of my money is in my brokerage account because I'm going to max it out. No, you should have some money in a home. You should have some money in a fund. You should have some money in managed by an advisor. And if things go really crazy, you'd say, listen, John, you've been my advisor for 10 years, but unfortunately I have to take my money out. I'll be back, but I have like this emergency here where I have to, you know, stay in this trade because it's so crazy. I just need to stay and live one day longer than the next guy who's capitulating. And I knew a lot of the hedge funds in my community were capitulating on quantum, and I was just like, I'm not going down with them. I'm gonna stay in this trade a little bit longer, and then predictably the stocks are collapsing now that there has been some capitulation. You know, it gets really painful when you see that happening because, you know, it just tests your like willingness to believe in your faith as an investor. Your faith is that markets are efficient. Your faith is that stock prices should follow earnings over the long run. But the long run is years and years. And any given day, your bank's going to call you up and say, hey, you're down 30 million on this, you know, you need to add more money to your account or we're going to reduce your position. And I think, you know, to your point, I guess to your question, there's no answer. I mean, you know,
so you could kind of have a range, right? Like, so Stanley Druckenmiller is probably a better proxy than Warren when it comes to like directional stuff because Warren's more endowment style, at least these days. He would think of it as like you kind of start with 10 to 20% notional, and that gives you the room to kind of go deeper.
Maybe in a macro.
He's super aggressive, but I mean,
maybe in a macro trade. Yeah, with the macro trade, that sounds right, but that sounds crazy for an equity.
No, I would think of that if you were comparing it to equities, it'd be like more like your total aggregate short exposure across all your shorts. That's a mistake. I meant like on the aggregate, you 10 to 20% notional. You know, you kind of saw where your conviction goes up.
Yeah, one of my partners some years ago was Robert Johnson, who was in the room, so to speak. He was like the number 3 or number 4 guy at Soros, with obviously George being number 1 and Stan being number 2. There was also Jim Rogers, who was pretty big there, but Rob Johnson was one of the legends. And he had some money in my fund. We had a good relationship. When it came time for the DOJ to interview them, he said, I will never say anything bad about Martin, ever. He made a lot of money for me, and I'm not, you know, going to help you at all. And I was so happy to hear that. And he wrote me a very nice letter while some of the other people weren't so nice. Anyway, Rob, you know, they were looking at these trades as a, you know, macro instruments don't move much, as you know. And so at least they're not supposed to. So you hope that like you can sustain the standard deviation on the downside, but what you're really hoping to do is you have that convexity where like you have your standard deviation against you is almost nothing and your standard deviation for you is massive. That's the dream. Unfortunately, obviously, the markets are efficient. And like if you look at quantum put options, otherwise you have have great convexity. And you know, so you're trying to find situations like that where the market's missed it. And needless to say, it's pretty rare. I wish I was buying Beyond Meat convertible bonds, you know, 2 weeks ago. I'd be up 30 or 50x. This is like the trade of the century. But the equity is not the trade of the century. That's the... You know, I mean, I guess if you bought it at $1, it's not so bad, but it's.
But then when you're restriking on the day, right? Like when you have these really crazy moves, the directional funds that tend to actually be really because they decay. Couldn't those sort of be like an interesting short-term option? Like if you are going to recast, right? You're getting the 1 for 1 or 2 for 1 daily move. So I've kind of been thinking about that. Like obviously you got to be careful with it because there's like that crazy decay.
Well, the problem is that it doesn't exist for every single instrument, right? Like, it'd be great.
Yeah, they have one for Rigetti now. They have one for IonQ. They have one for QBTS. So they have a couple of them out.
But not so much for Beyond Meat. But yeah, I'm with you there. I mean, I think of Beyond Meat, it's almost like, are you willing to short call options here, which feels crazy. I'm not willing to.
Just because the moves at 200% a day is like, you know, you could see, you know, 20 for a second before you.
Right. But theoretically, if you're willing to short at 4, then why not sell a 450 call? I think the problem is most people will get greedy and say, Well, I saw a lot of 450 calls, and the reality is like you should only sell as many calls as you were willing to short common, and I think that's the kind of where, you know, you have to go
back to your notional capability, and that's what I think a lot of people miss is you have to just like assume that it's going to blow out.
Well, this goes back to like the original best advice I've ever gotten that I never ever follow, which is you keep your position sizes as small as possible. The best trader, you know, it sounds like you're a buy-sider or a sell-sider or soon to be one.
I'm general macro. I run a fund and I do some stuff in my PA.
Yeah. So you're a pro, and I'll just tell you a pro to pro story, I guess, is I was I left the Tiger Cub and I was starting my own fund, and I shared an office with this guy who had his own fund in Connecticut, and he was one of Steve Cohen's partners early on in the early days of SAC, and he was, you know, supposed to be one of the best traders, you know, ever, and he just managed his own money. And I borrowed his office. We were just mutual friends of my old Tiger Cub boss, and we're still all friends. And so I sit there and I'm like setting up my fund, and I'm getting to watch him trade a little bit and see how he did it. And what was crazy is he never really tried to have gross exposure of more than like 30%. So
I knew you were going to say exactly that. I don't know if it's you who I've heard it from
probably, yeah.
Before, but that 30% is exactly what I've had in mind for the last minute.
Like 𝗏𝗏post is like
classic.
𝗏𝗏post is kind of like that too, right? And it's like I was sitting there, I'm like, of course I'm running like a PA or like maybe my fund had started, I don't remember, but I'm like 180% gross, and I'm like sweating bullets, trying to make 2 cents, and nothing's working. And this guy's like, no, I put money to work. I know I'm right. I'm 100% sure. If it even goes against me a tiny bit, I'm out because I'm supposed to be right? And I'm just holding all that cash for no reason, just because, more quite frankly, my investors are shoving it in my hands more than anything else. And I'm just like, what a legend.
Well, one of those guys, not that many good trades, that many like great trades to be done. It's like you're like, right. I don't know what he was trading, but like you can't always trade like whatever he had available, like 15 million.
Well, it goes back to the volatility on the underlying, right? Like it's going back to what Martin said before. Like if you're trading macro, you're trading something that's super deep that you could source a lot of leverage. You could be notional 300% waiting for a 1% move. At the same time, you could be making a 1% bet where you're expecting 20, but you're going to go to 0. So I think you also think about like what's inside that 30%. Like how is leverage being sourced inside of that exposure?
Well, I think what's interesting about my friend who is a tech portfolio manager, and now I've almost doxed him, but you know, he retired at like 42. His investors were so desperate to have them. He never had a down quarter in his career. He's had down months, but never had a down quarter. And he his investors were so desperate to keep going. When he retired, they were like, please just run our money like even like as a hobby, like almost like passively, like just like you don't even have to like invest all the time, just like do us a favor and just like whenever you feel like investing, invest it. And he still said no, but he was just basically so convinced.
Top news alert: Trump begins demolition to prepare for White House ballroom.
When you only have winners, I mean, it's very hard not to compound at a huge rate. I think the hard part is saying no. I mean, when you have he's running 300 or 400 million, and I think it was like half his own money, and when you're sitting there saying, you know, you have every broker calling you, you have every analyst that you employ telling you about their favorite stock, and you're just saying no, not good enough, not good enough, not good enough. The ones that do make it through your, you know, pattern recognition and your, you know, back in the days in tech, you had to like have quote unquote edge, which sort of was synonymous with insider information, which is why I never kind of did too much tech investing, or when I did do tech investing, I tried to avoid that kind of thing because it just didn't feel right as an investor. But you still can't really do tech investing without doing like very deep channel checks. And those channel checks, depending on who you ask, they're sort of getting pretty close to the line on insider info often. You have to be very ethical, I think, about not sort of trading when you know what tomorrow's news is. But in any event, that sort of having that mix of edge, which is legal, and it doesn't cross the line, and then also conviction and experience and pattern recognition of kind of what works and what doesn't. This guy was so good, especially at reading people, that in the tech, again, the tech investing world is so different from other fields, that he would call managers, and the managers would, he would just sort of, you know, just chat with them, basic stuff. And then he'd hang up and he'd be like, what do you think? And I'd be sitting there, again, we don't work together, we're just friends. I was like, I don't know, sounded fine to me. Seems like, he's like, they're gonna miss by 16 million. I was like, what are you talking about? And he's like, I just heard it in his voice. I could tell. Consensus is at 800. I think he's gonna do like 785. He's reporting 3 days from now. And I'm like, and you know,
priceless intuition, just that old man intuition.
Yeah, and I think once you've, and again, he wasn't an old man at the time, but it was kind of like one of these things where, yeah, I could see like a Leon Cooperman, you know, if you've done this for like 40 years of like trying to guess the quarter, you know, you can kind of pick up like just the way people react and things like that. And again, I never liked that game because it's not investing. It's kind of this weird, like, you know,
intuition synthesis.
Yeah, and it's important because in tech, that second derivative can kill you. Like if a company's growth has slowed, like imagine NVIDIA, you know, I don't know what the current consensus is, but like, let's say it's for 30% growth and they come in at 20% growth, it's all over. Like it's done. Like just that little directional change is enough for...
Yeah, this total multiple reversal.
Yeah, it's a disaster. And it's path dependency that, you know, is important. That path dependency, like you might ask yourself, a lot of people ask like, okay, Palantir, consensus growth was for 35%, they came out at 40% growth. How could this be a 10, you know, how could this go up 30% on that? And it's like, well, think about it. Do the path dependency of like, they went from, like Palantir is really interesting if you look at the income statement, they went from 20% growth to 25 to 30 to 35 to 40, 45. And it's like, the rate of change of their growth is positive, which is insane. Usually as you get bigger, it's harder to grow. And then the profit margin is, you know, this, everyone likes to quote the price to sales, but it's 50%, you know, cash flow margin, not even operating income or anything. It's like 50% net margin. And so it's a unique software company. It's kind of almost like, not even a software company. It's almost like a hedge fund. I hate to say it because it's not, doesn't respect Palantir enough, but like, the reason I say it's kind of like a hedge fund is when you listen to Alex Karp, he says, when you use my software and I save you, let's say 100 million, you guys are gonna have to pay us like 20, 30% of that savings. And that's the way software should kind of work, at least the way he does it. So if he goes into a big fat organization that's like, man, we spent $500 million a year manually doing this. And he's like, got you, I'm gonna take that 500 million and make it 50 million. And they're like, really, you could do that? Because my shareholders would love that. Imagine if you're Pepsi or something. And he does it, and now he's like, great, you know, that's going to cost you 100 a year, so you're going to...
Well, it's his performance allocation. It's like, it's perfect alignment, and I think that's also part of why they've done so well.
Yeah.
He's very good at structuring that kind of thing, and if more SaaS companies did that, they would either do better or they would fail faster.
Well, that's the thing. I mean, I think most SaaS companies can't do that. If you know the old days of SaaS, I was an enterprise software analyst 25 years ago, or 20 years ago, and you know, most SaaS customers, you talk to the CTOs and you ask them how their SAP deployment went or something like that, and they're like, oh man, it was, not only do we have to pay SAP a fortune, we then had to pay Accenture and IBM a fortune to integrate it, and it broke everything, and like half these SaaS ERP deployments didn't even work, and they had to gut it out and try again, and you know, so...
Yeah, 90% of them just literally decay into a sales organization that's harvesting existing licenses if you actually look deep in the space. I do a lot of work deep in that space, so I know, and that's why you kind of see the new companies like Palantir will just come in and take major market share every couple of, you know, years or every decade or so when the whole stack has to get rebuilt. The legacy is just not fitted to rebuild that stack.
Yeah, and that's how sort of Salesforce, you know, kind of ascended. In just like completely escaping the client server model and just say, let's just go to the website. You know what a website is. Let's just do this all on the web. And, you know, nobody thought you could do that, but they did it. And then, you know, I guess the value of the software 10x'd in a way, because you could have your sales, you know, team or CRM or whatever it is. It could be a Workday, it could be anything. And it's just there all the time and it always works. And that allowed, you know, there were not many $200 billion software companies back then. There's really one called Microsoft, and you know now they're a number of them. I mean, some companies you don't even really know much about, like ServiceNow and, you know, Workday and like stuff that's like, how are these guys so big and successful? And the answer is the SaaS model is really great. And now we go to this next model, which is like, almost like you said, like a performance allocation where, as you said earlier, the reason 𝗕𝗲𝗏 and Vista, is it Vista? Or the other, you know, whatever 𝗕𝗲𝗏𝗏's like brother company is, I think it's called Vista. Their rival, you know, they're able to buy these old software companies for like 1 or 2 times sales because they're so deeply embedded. And 1 or 2 times.
They're also just they're dead, right? Like if you really look terminally, they just don't have the stack. The engineers that built the stack don't work there anymore, right? So they just kind of have a book of clients and they have a brand, and then you have to figure out like, can you adapt that? Can you harvest that license? Nobody really talks about it that way, but I think behind the scenes, it's like a lot of what goes on, at least at the scale. You know, at this like the small business consumer app type level, it's very different. Like you said, it's just go on the website and buy it. But if you know enterprise, it's like these custom solutions for anybody more than 50 million. It's like this totally different game.
Oh, it's awesome. And you know, the company Constellation, which is kind of like the Canadian, almost like a Canadian Berkshire at this point. You know, they've done hundreds of these acquisitions for 1 or 2 times sales. It reminds me of pharma, where you have this like massive margin that will never ever deplete because, like you said, I mean, getting rid of some like legacy software that's embedded for 40 years by some government, you know, purchaser, like will freeze over before they change. Like how hard it took to like change the Social Security software.
Yeah.
Right?
And nobody builds the new stack, right? Because everybody that starts a company just wants to build a narrower use case that they can bring to market, right? They're not going to go into your company and actually take your whole business and customize a full vertical around it, right?
Yeah, you can't upgrade. You can't. I mean, JP Morgan is still on Python 2, and
they're probably on 10 different things, right?
Oh, for sure. But like my friends that work there at 𝗏𝗏 are like, we have to go back to Python 2, which you know is sort of decommissioned at most places 10 years ago. And we're like, we don't even know what's going on in software today because we're stuck in 2015, and like we're searching for things that happened 15 years ago instead of staying on the cutting edge. Facebook may be on the cutting edge, but at JP Morgan, you know, there's mainframes from IBM from a long time ago. There's all that stuff, and so you know, tech is what it is. But anyway, far afield here. But I definitely think that you know, getting back to the point of like, how do you make sure that, you know, you're not in over your skis? Palantir, I was going to say the best advice I've ever gotten, both from this guy and then also just seeing Palantir Jones say this. He said the mistake almost everybody makes trading is they trade too much and they trade too big. And what's a 5% position should probably be a 1% position. So I've learned this over time. So my first trade here, just maybe instructively, it hasn't made me any money yet, so I wouldn't call it too instructive, but at least my approach is kind of what you're asking about, is what's the approach. My first trade was shorting at 365. This kind of like, it had like at around 3 o'clock, it like had this like sideways movement. So I made like a 5 basis point short to start. And then I added like 5 more. So it was 20 basis points. And I didn't want to go 20 all at once because the stock had been highly volatile. So I said, you know, let me do 5 basis points, like, I don't know, every 5 minutes. And it was just a feel thing. And I got to 20 basis points, and I was sort of happy. And then, you know, I started this call. I wasn't happy because I was up. I was just happy because it was like, all right, this is more or less kind of what I'm comfortable with so far. Let's see how it plays out. If it started to go down, I'd probably short more. And if it started to go up, I'd probably short more. So it started to go up, and I shorted a little bit more, and then I shorted even more. And now I'm sitting at a 1% position at around a $4 cost basis. And again, I think I'm probably too big even right now. But in the old days, I'd probably be up to a 3 or 5%. And
what year did you first start shorting Beyond?
Oh gosh.
Like forever ago.
Yeah, it's been a while since I traded this. Like 3 or 4 years ago, maybe 4 years ago. Around the IPO. There was a mini bubble back then when like, everybody remembers, like that was when SoftBank and Tiger and a lot of people were just splashing money at the market, and it basically just went public, and it was just this like very fast tailspin. But I think that yeah, like I used to want to go heavier in these things, and I've just learned to back off, and the results have actually gotten better by trading smaller, less aggressively, and less amounts of money, because, you know, again, I think like you do far better when your losers are minimized. It's okay if your gains are also, let's say, cut in half, if it makes all your losers go away. That's like a huge, huge thing. And when you leave yourself that comfort room of saying, well, I start at 5 basis points, I can double down for a long time. If I start up at 20 basis points, well, you know, it takes a lot to change my position from 360 to 4. You know, that required me to like 4x or 5x my position. Now I'm at 1%. Let's say the stock goes to 10. Well, do I really want to have a 10% short in Beyond Meat? Maybe, not really. Maybe I'd want that at like 50. So like, you just have to ask yourself, when will I have enough money left over so that I can make a big bet if the opportunity presents itself? If it goes right back down to 1, I'm happy. Short 1% and my IRR is really good. This is kind of like my friend that I mentioned. That's the kind of, you know, thing he would do. But like some people, a lot of people as traders, they want to wait before they get like what some traders call like a confirmation, basically, that it's going down. I don't really believe in that. You know, it's just like, there's something about me that's very stubborn about believing in these like technical like indicators. To me, they're just like, just random opinions. They don't mean anything. But certainly there is some truth to the point that, let's say Beyond Meat was at 2, you know, 2 days from now. Well, like, it's probably going to keep going down to pennies. And you may be more profitable shorting it at 2 than wrestling it with up here, like wrestling an alligator at 4 or 5. It's kind of like this painful, like, who knows what will happen? Maybe it'll go to 20, you know? And by the time it goes to 2, it's like, all right, it's not going to go back up to 20, right? It's dead. So a lot of people, my peers, like to wait. They like to see it kind of corrode before they start piling in. And, you know, I kind of don't care. Like, to me, if it's a bad company, it's a bad company. I'm just going to short it. Who cares what the price action says? At the same time, like, the improvement to that is you can feel that way. You just don't go too big because you don't know what the market, you know, has to hold. And shorting at 2 to me feels like, okay, I knew it was 4. I know it's 2. Why did I miss this 50%? Let me just short it at 4. And it has this, it's kind of like a fish that you just bring out of the water. It's got this, like, it's like, you know, it's shaking, it's crazy. And it's almost like, wow, this thing is really, you know, really kicking. And then, you know, at some point it stops kicking. And, you know, do you want to short it when it's still kicking like crazy? It might go to 20. I don't know. You know, it's hard to say. But I also think, I was telling people earlier on YouTube that one of the best things about investing is that forget short, you don't have to short. Just avoiding stuff like this on the long side is like enough to make you money. Because I was watching this great video of this great investor, the 𝗏𝗏𝗏 at the Children's Investment Fund, ECI. And this guy's like, you know, maybe like a Buffett-like investor. He's extremely good, I think, long only. And basically, he ended up, he basically says that like 99% of stocks out there are not suitable for his portfolio. And it's like such a crazy thing to say, but when you stop and think about it, it's really true that like there are really only a couple percent of the companies in the world that are exceptional and worth investing in. Beyond Meat is not one of them, spoiler alert, but nor are most companies. And like biotech is a good example. I don't think anybody out there should really be trading biotech stocks unless they have like a very good sense and some experience. Now, maybe they do it small, but even then, like, are you really, you know, ready to trade against me or Rod Wong or Joe Edelman or, you know, Baker Brothers or whoever's good at this and ready to outfox them because they have a lot of capital, they got a lot of people, and they're out there in every stock. And so, you know, do you want to bring that gun, you know, the knife to a gunfight? Or, you know, do you stick to like some really, really high quality companies? Chris's favorite stock was GE Aerospace. And basically this engine business, this engine market is so complicated, but it is in essence like the biggest moat ever. There are only so many airplane engine makers, and like you don't just flip flop what airplane engines you use. You know, if you're Boeing, you're just sticking to it. And you look at Beyond Meat, it's like, look, this is a VC company, right? This is a startup. This is a company hoping to do the impossible, which is why their rival is called Impossible Foods, right? It's extremely unlikely you're going to change the way human beings have been eating for the last, 50,000 years. The chances that you're going to do that are astronomically low. So why would you want this in your portfolio? You want to make crazy gambles? I mean, go to Vegas, go to AC. What's stopping you from doing crypto? What's stopping you from going, online gambling?